Today marks the start of what may just be the most important 2 weeks in finance, following a disastrous Q1 with Omicron and a Russian invasion wreaking havoc on the markets. A new problem is emerging. Earnings season has begun, and we will soon find out if we're headed towards an ugly recession, some predicting worse than 2008, or if all of this bad news was overblown and we're headed straight up again. Today's video will undoubtedly have you rethink where we are going. Is this Armageddon or the promised land? We begin with the obvious. Right now, the situation is a bit bizarre. We have the S&P 500 down about 20% and the Nasdaq down about 29%. Now, everything we know about stocks boils down to one thing. How good of a business are you running? And one of the best metrics, essentially the one value that measures performance, is earnings. How much value are you giving back to stockholders? Before this downturn, earnings were at record highs, but something bizarre is happening. Forward earnings, or the numbers we expect to have in the future, didn't budge despite the massive downturn in stock prices. This mysterious outcome has everyone confused. Either the analysts are way wrong or they know something we don't. This report from Yardeni Research, published weekly, captures this situation perfectly. If we look at the S&P 500 forward earning estimates for each quarter of this year, we can see that analysts are predicting better and better earnings for the rest of 2022. If there truly is a recession coming, this should not be the case. As you can see in 2008 and 2020, when things get bad, analysts are typically good about revisions. They often do lag actual data, but regardless, they never get overly optimistic, and the spread between actual earnings and estimated earnings never gets too wide. This graph towards the end of the report showcases the accuracy of this. It follows S&P 500 revenues per share, actual versus estimated. The red line is the forward, or what analysts were guessing, and the blue line is the actual revenues. Throughout history, it has generally been very tight, even during turbulent times like 2008 and 2020. Today, you can see that the spread is widening, and one of two things is happening. Either analysts are right and we thrive going up from here, or they're just plain wrong, terribly wrong, and the spread continues to widen. The reason people are so worked up about this difference is that there's plenty to be worried about. Inflation is at 9.1%, and we have companies warning about layoffs. Housing is cooling, and the whole situation in Europe is deteriorating fast. There just isn't a lot of good news, and when uncertainty rises, Wall Street is quick to price in risk, lowering evaluations and cutting stock prices. The feel of the market suggests that things should be a lot worse, but analysts seem oblivious, and it's frustrating everyone. But what if the second half of this year isn't what's being reported? Maybe we're all being a bit too pessimistic. Let's for a few moments entertain the idea that things aren't that poor. This week we got a new report suggesting that retail sales aren't that bad, an indication that the consumer is still spending. In a statement by the Commerce Department, estimated retail sales rose 1%, beating the estimate of 0.9%. Then following that news, Jamie Dimon, CEO of Chase, a man who just a few weeks ago told us there was an economic hurricane coming towards the United States, the same man in an earnings call just said that the consumer is still strong. Wells Fargo, one of the biggest banks in the world, reinforced this theory, outright saying there is no meaningful deterioration in consumer spending. So we're at this point where everyone is sort of confused. On one hand, based on stock prices and GDP, we're expecting a recession. On the other, it seems that Wall Street is not so sure about that. And for even more evidence, look no further than median checking balance. This stat measures people's actual bank accounts, and you can clearly see from the data that we are on the rise, which makes no sense if we're entering a recession. Now, enough with the stats. Why then for this confusion, this divide that is making everyone rethink their investment theory? Well, for one, we are still unsure about two very important events that ultimately decide where we are headed. One is the situation in Europe, specifically related to Russia's aggression and its energy policy. If the Russian Nord Stream 1 pipeline doesn't come back online following its maintenance period, all of Europe is going to be in a very serious situation. Germany has already decided if the gas doesn't begin to flow by Monday, they're going to assume the worst. And when energy constraints hit the European continent, you usually get a very bad outcome. Take a listen to Luke Groham explain the potential disaster that awaits Europe should Russia go down this path. But before the clip starts, make sure you hit that like and subscribe button if you're enjoying the content thus far.
Europe is effectively running the same economic playbook vis-a-vis Russia and the gas situation as Weimar Germany did in the aftermath of World War I, after the French seized Ruhr Valley coal stores, which is take away some of the energy supplies and then print over money to try to maintain the nominal economic, some nominal economic illusion. What you end up doing is hyperinflating.
So there you go. If this turns out to be a real energy crisis in Europe, the potential for hyperinflation increases dramatically, and we are already seeing the euro weaken to 20-year lows. Of course, a situation like this would have a dramatic impact on worldwide markets. Don't forget that the 2008 Great Recession actually started in Europe. On top of this dramatic development, we have another massive risk on the horizon: inflation. Recently, the latest numbers were absurd: 9.1% CPI, something we haven't seen since the early 80s, and to make matters worse, the central bankers aren't really interested in fighting inflation the same way they were fighting it with Volcker. The spread between the inflation rate and the risk-free rate is very wide, and that has everyone concerned that inflation may not actually peak anytime soon, while inflation expectations remain relatively flat, suggesting that people still believe it will come down. It's rather alarming that we've had such a long period of increases with no end in sight. Unless there is a rapid development concerning the war and energy crisis in Europe and there is evidence of inflation peaking, I don't foresee the risks minimizing nor the stock market stabilizing. Whatever the case may be, it's now earnings season, and we will find out very fast how wrong or right these analysts are. Their expectations are wildly out of sync with the current market, and hearing from CEOs directly about the state of their business will hopefully give us the details we need to know. On July 28th, the new GDP number will come out, and we will officially know if the recession has been avoided. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it.